So we got that strong jobs number for June, and the Bank of Canada is set to announce its next interest rate decision July 30th. Does this sign of strength in the labour market make it less likely our central bank will cut borrowing costs? Let's get perspective from Randall Bartlett, Deputy Chief Economist at Desjardins. Randall, great to talk to you. It is just 1 month, I know, but what did you draw from these job figures?
Well, Andrew, maybe just 1 month, but what we have seen from the labor market is that it has come in, I think, stronger overall than a lot of economists have expected in recent months, given the trade turbulence we've seen in our relationship with the United States. And so today was, just completely outsized relative to all expectations. Markets expecting a flat print came in at plus 83,000. And so it is just one print, but I think it follows, economic data that has been weak overall, at least in the real economy and labor market front, but hasn't really pointed to the sort of doomsday scenario that many of us had been expecting earlier in the year.
It's interesting, isn't it? Yeah, you would expect, let's be thankful it hasn't happened, but you would think even worse job losses with what's apparently something of a freeze in investment amid the tariff uncertainty.
No, absolutely. And you're seeing it in the trade data where exports have tanked, imports have come down as well. We're seeing it in the manufacturing sector where we saw that output has been weak. We're seeing it in weak auto sales. We're seeing it in indicators across the board. But where we're not seeing it showing up, particularly in June, but even in May, was in the labor market, where we've seen that the labor market has continued to edge forward and, in fact, got a pretty healthy bounce in June, coming from sectors like retail trade, where we would have expected, given what's happened with the Hudson Bay Company and the broader economic uncertainty and weakness, that we would have seen, flat to potentially negative job gains in the month, and that turned out to be a bumper month overall.
What at your shop, or you yourself, what is your feeling about the Bank of Canada? Will they be tempted to cut?
Well, we think with the bank, it's going to rely significantly on what we see in the inflation print for June that's going to be coming out on Tuesday. When we look at what the Bank of Canada pointed to in April, when we had the NPR come out, and then again in June, what the bank pointed to was underlying inflation, sort of its preferred measures of core inflation, still more elevated than it would like. We saw that in the May data, they came in a little bit. We're expecting to see that again in June, but the question will be, will the Bank of Canada lean more heavily on the inflation data if it doesn't come down as quickly as it would like, or the weakness we're seeing in the broader economy? And ultimately, this strong labor market print today takes reduces the likelihood that we will actually see a cut at the end of July, even if that's still our base case today, and a lot rests on next week's inflation print. The job data is super solid, so you can't entirely look through it.
Long-term unemployment going up, and I think you guys, economists, you see that as particularly damaging, because the longer somebody's out of the workforce, the more out of touch they get, and the more demoralized.
Yeah, it's true. So we continue to see that long-term unemployment is elevated. We see that that other indicators of longer-term structural labor market health are certainly weak. But we have seen that layoffs, the layoff rate has basically matched what we saw a year ago. It hasn't been accelerating at the sharp pace that we would have expected it to. Again, we're seeing that we've had these persistent job gains over time, even as real economic indicators turn very weak, including in sectors where we're still seeing hiring in the labor market data. So, the labor market data, when we look at the labor force survey, it's highly volatile. It's anyone's guess where it's going to come in on a month-over-month basis. Reliable indicator on a sort of a trend basis, but not really month-to-month. And so we'll see ultimately what it means for the third quarter and economic activity there. But ultimately, the Bank of Canada, we think, is going to put less weight on this, in part because of the volatility, and more weight on that inflation print next week when it makes its final decision at the end of July.
Wage gains are continuing to slow. What does that tell you about the labor market?
Well, I think slowing wage gains tell us a couple of things. I mean, part of the story is the fact that we've seen inflation come down considerably from where we were a couple of years ago, and ultimately, inflation feeds into wage growth, and can be a potential wage price spiral, of course. But ultimately, when we start seeing consistent inflation gains of around 2%, that gets baked into wage contracts, and then ultimately that ultimately supports wage growth, which is supportive of the Bank of Canada's inflation mandate. Also, I think there's a lot of uncertainty out there. We're seeing a lot less hiring on the part of employers. We're seeing lower job vacancies across industries, and so there's somewhat less labor demand. So even though we're seeing relatively healthy hiring, demand's not as strong, which means there's not as much push for higher wages as we've seen in the past.